Welcome to This Explainer. Today, we're setting the stage for an absolute clash of titans in the cryptocurrency market of July 2026. We are looking at an epic, high-stakes showdown right now. By the end of our time today, you'll know exactly what's driving this chaos and how to navigate the fallout.
So let's start with our central mystery. Why in the world is a thriving $2.3 trillion market completely paralyzed by extreme fear? We're talking about a space that rivals the GDP of major nations, yet investor confidence is just in the gutter. It's literally like watching a massive, coiled spring just waiting for a catalyst to snap.
And just look at the sheer scale of this paradox, $2.3 trillion. Even with a pretty solid 1.4% surge in global capitalization over the last 24 hours, that massive number is hiding some serious, deep-rooted macro tensions. This isn't a market resting comfortably, it's a market holding its breath.
What's really fascinating here is this dismal score of 25 on the Fear and Greed Index. Out of 100, a 25 lands us squarely in the extreme fear zone. It proves that a huge chunk of market sentiment is totally gripped by anxiety. We're in a liquidity-driven consolidation phase right now. Investors are basically sitting on their hands, hoarding capital, all because the signals coming from the broader economy are just incredibly conflicting. Let's break down where this conflict is actually coming from, starting with the massive macroeconomic forces at play. We've got two opposing heavyweight forces squaring off. In one corner, you have a massive risk-on signal. We're seeing cooling PCE inflation data and a tech rally heavily driven by huge corporate earnings from giants like Microsoft. But all that optimism, it's getting completely neutralized in the other corner by a hawkish Federal Reserve. They're sending 10-year and 30-year Treasury yields to levels we literally haven't seen since 2007, along with a super strong US dollar. It is a textbook macro stalemate. Digging a bit deeper, the absolute crux of the issue is the Federal Reserve's latest policy decision. They went with the hawkish hold, flat out refusing to cut rates and stubbornly maintaining their 3.50 to 3.75% target. That restrictive posture is exactly what pushed those Treasury yields to 2007 highs. Think of this yield like a giant gravity well. It exerts this intense downward pressure on risk on assets like crypto, basically sucking all the liquidity right out of the room. And just to add to the chaos, the Fed is refusing to give any clear forward guidance on future rate cuts. The market is scratching its head trying to make sense of booming corporate earnings alongside a central bank that just won't show its cards. It creates this massive, heavy uncertainty premium that everybody is forced to price in. Now, let's pivot to see how these macro shockwaves are hitting the actual crypto battlefield, specifically looking at the institutional players. If we look at the mechanics of the localized volatility we're seeing, Bitcoin has been wildly fluctuating between $64,000 and $65,000. Why? Well, we just went through the largest derivative settlement of the quarter with the July monthly options expiry. Market makers are out there aggressively adjusting their positions. Mix that with a cluster of high-leverage long positions sitting right around the $66,000 mark, and boom, you get a violent cascade of liquidations and some immediate price softness. Behind the scenes, there's a crazy institutional tug-of-war going on. On one side, you've MicroStrategy. They just reported holding a mind-blowing 843,775 Bitcoin. That is a 25% increase year-to-date. It's a huge signal of long-term conviction, right? But then, on the flip side, U.S. spot Bitcoin ETFs have recently shifted to net outflows. This tells us we're hitting a temporary plateau in immediate demand, mostly as fund managers just lock in gains and rebalance their portfolios for month-end. But it's not all doom and gloom at the top. Let's zoom in on the trenches where decentralized finance is actually mounting a pretty impressive counterattack. DeFi is showing some serious resilience right now. This sector is logging a 2.6% recovery, which is huge because it finally snaps a brutal 5-month decline in the DeFi lending market. It's solid proof that on-chain capital demand is slowly but surely finding its way back into the ecosystem. But make no mistake, the altcoin battlefield out there is absolute chaos. Take Uniswap, for example, surging over 12% after dropping a new token issuance portal. Then you have GRVT exploding upward by an unbelievable 62%. But in that exact same 24-hour window, the Lorenzo Protocol, or bank, suffered a devastating 57% crash. It is very much a highly volatile stock picker's market in crypto today. And all of this volatility leads us right into the shifting regulatory landscape. Over in the European Union, the MiCA regulatory sentinel has completely awakened, and a massive, highly anticipated deadline, July 1st, 2026, is officially here. This is the regulatory template the entire world is watching, and it just dropped the hammer on the industry.
What's really keeping industry leaders up at night is the compliance gap. Firms are desperately scrambling to deal with this deadline, which strictly mandates that all crypto asset service providers in the EU must now be fully authorized. The legacy window is closed. That means the vast majority of firms that were operating under those old rules are now sitting in a highly dangerous regulatory gray zone without a safety net.
The consequences for non-compliance here are absolutely brutal, which is forcing a massive, rapid migration of trading volume as users flee to fully licensed, compliant exchanges. And the heat isn't just turned up in Europe. Stateside, SEC Chair Paul Atkins has clearly indicated the agency is ready to aggressively step in and create new crypto market rules if Congress fails to pass the Clarity Act. So we're seeing regulatory sentinels surrounding the market on a global scale.
So as the smoke starts to clear from these liquidations and sweeping regulatory deadlines, we really need to look at what's coming next on the horizon.
The good news? The long-term store of value narrative for Bitcoin remains perfectly intact. The network fundamentals really haven't skipped a beat. However, the immediate liquidity is entirely tied to macro data right now. Investors are hyper-focused on one specific upcoming catalyst, the August 7th labor market report. The entire market is basically holding its breath, desperately waiting for a signal that the Fed might finally pivot on digital asset liquidity.
Ultimately, the biggest takeaway from this explainer is that the next major liquidity shift hangs entirely on the balance of that upcoming labor data. If those numbers soften, the Fed just might pivot, and we could see that extreme fear flip to extreme greed practically overnight. So I'll leave you with this final thought. As these macro titans clash and the global regulatory landscape permanently shifts, are your assets positioned to survive the fallout, or are you about to get caught in the crossfire? Keep your eyes on the data and stay sharp out there.